it's Lee. If you're on a mortgage deal at the moment and it's due to expire, if you do nothing about it, almost certainly your payments are going to increase. So now's the time to think about looking at getting and securing a new deal. So what are your choices? So the first and most popular choice is that you organise a remortgage. A remortgage is the full underwritten process of moving your mortgage from your existing lender to a new lender. The advantages of organising a remortgage are that you can source the whole of the market and make sure that the new deal that you secure is the best deal that's available at the market at that moment in time. What it also allows you to do is potentially make changes to your mortgage. You may want to change the mortgage term, for example. So you may want to reduce the term to get it paid off a little bit earlier. You may want to extend the term to give yourself a little bit more flexibility around payments. You also may wish to change your level of borrowing. For example, you may want to borrow more money to fund home improvements, to purchase further property, or maybe just consolidate some debts that have been building up. But there are some disadvantages of doing a remortgage. The first is the amount of time it takes. It potentially takes anywhere between 6 to 8 weeks, and sometimes it can be a bit longer, to get this completed. You may also incur fees, so there could be fees to the lender, there may be redemption penalties or fees to your existing lender, and if you use a broker, you may also incur broker fees. As I already mentioned, it is also a fully underwritten process. So what this means is your whole sort of credit worthiness will be checked. So your payslips, your bank statements will be required, a credit check will be carried out, and also the property will need to be revalued. All of these are things that could affect the level of borrowing and your ability to get the mortgage you require. There is another alternative. You can look to do a product transfer, and this is really simple. So this is basically staying with your existing lender and taking a new product rate with your lender. Now, there are huge advantages for doing this. It's much quicker. There's no valuation, there's no underwriting, they don't need to see any pay slips. Literally, you select the rate that you want and you select the date you want it to change over, and then the mortgage will instantly or automatically switch over to the new product at that point. Obviously, we would advise you to take advice whenever you are reviewing the mortgage. So even if a product transfer is the best option, having an advisor look at the whole marketplace to check how it compares against the competitors is quite a useful exercise. The good news is most mortgage brokers, because of the reduced workload on a product transfer, potentially or may not charge you a fee, because the work they have to do is considerably less than what's involved in organising a full remortgage. So if you're getting close to the time, I suggest you review your mortgage. We would normally say to clients at least 3 months before your deal is due to end is the ideal time when you should be thinking about looking at your mortgage, looking at your options and getting another deal secured and in place. Failure to do this potentially will mean you end up on the standard variable rate, which invariably will incur and make your costs increase on your mortgage. So this is Lee signing off. As always, look after yourself, look after your money, because money matters.